Okay, good afternoon. So I'll take you through my paper that's with a subject of unlocking MSME credit, and this is informed by sector-specific insights from Kenya. Now, I'll begin this presentation by grounding it with the facts. 40%, MSMEs contribute 40% to GDP, and the government's ambition is to grow this contribution to 60%. And this makes us just understand that MSMEs are just not going to be participants in this economy, they're also going to be key strategic levers to the government's growth agenda. Now, one thing we have to appreciate is that this ambition makes sense, given that out of the 7.4 million SMEs, although this data is dated, about 1.5 million are licensed. This means that there is a massive 80% of MSMEs that operate in the informal sector, and this informality means that there are repercussions around the access to credit, as well as weak regulatory oversight. And this just suggests that for the government to meet this ambition of growing the MSME contribution to 60% of GDP, it means that more MSMEs need to be formalized. And also, if we as a country want to actually achieve this inclusive growth, the MSME sector is where it's at, given the fact that they're socially indispensable, already contributing about 85% to non-farm jobs. This means that 9 out of 10 livelihoods, especially for underserved segments such as women and youth, actually rely on the MSME sector. Now, when we dig a little deeper, we see that the MSME component comprises micro-enterprises, small enterprises, and medium-sized enterprises. Now, 98% of that is micro-enterprises who are largely very informal, have very low capital, as well as being survivalist in nature. And this may actually explain why Kenya has a near 2.2 trillion financing gap for MSMEs. And some of the responses I got from industry players as to why this financing gap exists is that these businesses don't look creditworthy, and thus we avoid them altogether. And for the businesses themselves, the issue is, at least the main issue, is around the fact that bank products don't fit their needs. Now, when you dig a little deeper into why banks or financial institutions are saying that these MSMEs don't look credit-worthy, it's largely on account of the fact that a majority of these businesses, as has been mentioned before, lack collateral, as well as not having business accounts, as well as proper records. And with respect to avoidance, this stems from the fact that there is a high cost of appraising, monitoring, as well as recovering loans from microfirms. And as such, a majority of financial institutions prefer to lend to the 2%, that's the small and medium size, who are more formal, traceable, as well as bankable. Now, we have to appreciate that MSMEs are getting funding, and their proportion to the total banking sector loan portfolio has grown steadily from 2017, from 19.2% to 21.4% as at the end of last year. Now, it comes as no surprise that a majority of the MSME loan accounts are actually from micro enterprises, given the fact that they represent 98% of the MSME sector in Kenya. But when we shift our focus from number of accounts to total value, we see that there's a staggering gap. These micro enterprises actually only got, at least as at last year, about 89.4 billion in funding, as compared to the small and medium-sized enterprises that got about 695 billion combined. Now, this is nearly 8 times the value that is going to a segment that constitutes only 2% of the MSME population. So while we may see that the banking sector ticks the box in terms of inclusion and based on growing reach, it fails the equity test on depth, as the smallest businesses, that is the micro enterprises, are starved of meaningful capital. Now, my paper. We're breaking down further just to better understand the sectors that benefit from funding from this, from the from this funding across the three segments. So we find that over 60% is spread across the three sectors, key sectors, that is trade, real estate, and transport and communication. Now, well, at first glance, as I've mentioned, it seems as if there is a micro access problem. This study does appreciate that, yes, the micro story is very real, but it's best to understand this from a sectoral lens, which is more analytically sound, but also aligns in the way in which banks allocate credit to the MSME sector, as well as how policymakers structure interventions. And that's the reason why I have used the sectoral analysis lens, so that I'm able to capture heterogeneity within the MSME sector, align with the GDP contribution trends, as well as identify any policy levels and targeted credit tools that can uplift the MSME firms. Now, the study is therefore trying to understand just the main financial and policy-related drivers of MSME credit across these three key sectors within Kenya, and how also the perceived credit risk as proxied by sector-specific NPL ratios affect banks' willingness to lend to these MSMEs, as well as the role in which sectoral economic opportunity, which is proxied by sectoral GDP, plays in credit allocation, and as well as the impact of the interest rate capping period. The objectives, just to evaluate the impact of financial health indicators on how this influences lending behavior to MSMEs, as well as assessing sector-level economic performance and how this correlates with MSME credit allocation, as well as to analyze the impact of interest rate cap period. Now, briefly, when I look at the literature, I won't go in depth into this. I'm using 6 key variables. Start with the dependent variable, which is sector-specific lending across the 3 sectors, that is real estate, trade, transport, and communication. I also look at the sectoral GDP across these 3 sectors, which is a proxy for credit demand, as well as the economic opportunity within each industry. I'll be looking at also the NPL ratio within these 3 key sectors, and this will be a proxy for credit supply risk. I'll be using the weighted average lending rates because the study was unable to get lending rates specific to the sectors, and this will just be the proxy for price of credit. I'll also be using the bank-wide liquidity ratio just to capture the bank's ability to extend new credit, as well as an interest rate cap dummy just to proxy regulatory regime shocks. Now, this is just a blueprint of the model. I use an irradial model, and I will speak to the pre-estimation techniques. I just came up with this just to show the flow. As I mentioned, key variables of interest is MSME lending, a demand side variable, that's the GDP, supply side variables, which is NPL ratio, lending rates, and the liquidity ratio, as well as the interest rate cap. The key pre-estimation techniques were the unit-root test, all variables except for the interest rate cap dummy, which is assumed to be stationary at I0. That's the only one that is stationary at I0. Also looked at the optimal lag selection, as has been seen on the screen, as well as the ARDL bounce test, which looks at detecting long-term co-integration, that is a long-run relationship between the variables. Now let's dive into the results. When we look at the real estate sector, it is highly rate sensitive, and the model suggests that credit to the real estate sector is extremely sensitive to lending rates both in the short and long run. When looking at the short run, higher lending rates are associated with higher levels of credit to the real estate sector, and this may suggest that developers rush in to just secure loans before any further rate hikes, which is a form of what I would say opportunistic borrowing in that sector. Now, when we look at the long run, we see that there is a very large negative coefficient, which is highly significant, underscoring how acutely real estate credit contracts when the lending rate rises. This just may be linked by the highly leverage nature of the real estate sector, especially for those medium-sized enterprises within that space who depend on project finance as well as construction loans for the success of their projects. Therefore, higher lending tends to result in many developers either lending rates, that is, results in many developers either postponing their projects or scaling them down because the cost of borrowing outpaces the returns, therefore resulting in balance sheet risk. When we look at liquidity, there is a negative relationship. That is, higher liquidity doesn't necessarily translate to higher lending to the MSME space, and it's generally in the credit space anyway. But this implies that when banks are flush with cash, they choose to park those funds towards safer, higher yielding alternatives like government securities. The interest rate cap period, no surprise there, shows there was a negative impact towards disbursements to this real estate sector. And this is because I believe that the interest rate cap discouraged risk-based pricing and forced banks to just pull back lending, especially for those sectors that they perceived as risky. We also look at the error correction term, which is appropriately negative, which just suggests that there is a long-run relationship between the variables. But then, as you can see, it's only 9.4%. That means that only 9.4% of shocks within the credit space towards the real estate sector come back. Are corrected each quarter, just suggesting that there are some structural rigidities that need to be taken into account. Now, when we're looking at the trade sector, more specifically wholesale and retail sector, we're finding that sectoral GDP does support credit to the trade sector in the long run, but the volatility and seasonality effects come into play in the short run, and that negatively impacts credit to that sector. This just suggests that the trade sector tends to grow steadily, but banks become more, it just suggests that when the trade sector is growing steadily, banks become more confident to lend to that particular sector. Now, in the short run, as I've mentioned, there is a negative relationship where we are finding that better performance in the trade sector doesn't really relate into credit to that particular sector and vice versa. And this can just be reflective of erratic revenue cycles as a result of seasonal demand, as well as maybe exchange rate shocks, especially for those that are doing exporting. Now, statistically, Kenya's trade sector, as you may all need to appreciate, is highly informal and thus very vulnerable to any shock onto the credit space. Now, in terms of lending rates, similar to what we've seen in real estate, we see that lending rates are a significant barrier to the trade sector in the long run, suggesting that a reduction in those lending rates could unlock credit access, and even marginal changes in lending rates have large effects on credit to trade. Now, the interest rate sensitivity to the trade sector could also imply sensitivity around, or rather related to low profit margins. Bank liquidity, again, no surprise, it seems to be a case that cuts across all sectors. Higher bank liquidity doesn't necessarily translate to higher credit, and this just suggests that banks are utilizing these funds, either lending to safer borrowers or parking those funds in government securities. Now, for the NPL ratio, we are seeing it being, or rather credit risk being a key deterrent to credit access for those in the trade space, both in the short run and in the long run, albeit not as significantly in the long run. This is what I would call a self-reinforcing loop, where you're finding that high NPLs result in increased bank caution and then credit contraction in that specific sector, and thus the increased chance of more businesses failing, thus sustaining or elevating credit risks within the trade sector. For the interest rate cap, again, no surprise, negative impact, but again, for the error correction term at 11.2% means that the credit to the trade sector reacts more slowly to shocks. When we look at transport and communication, again, highly sensitive to lending rates in the long run, and this just reflects the nature of MSMEs within this space, as they often operate on thin margins and short cash flow cycles. We also find that the bank liquidity ratio as well is negatively correlated. Again, banks with flush with cash either park these funds with safer borrowers or in government securities. GDP is positively significant in influencing credit to this sector. This is no surprise because at least you're able to monitor movement or rather traction within this particular sector. interest rate cap negatively impacts credit, no surprise there. Now, what does this all mean? As I've mentioned, lending rates across the board seem to be the biggest bottleneck across all sectors, and the model results show that credit uptake is highly sensitive to lending rates, confirming that MSMEs' access to financing is meaningless if pricing makes loans unaffordable. The second point is that even though banks may be liquid, this does not necessarily correlate with higher MSME lending, at least from the results across the three sectors. And this suggests risk aversion and crowding into safer assets, such as government securities, rather than flowing funds to the small businesses. Another key point is that the model shows that the GDP effect on credit is inconsistent, which could possibly reflect delayed transmission, seasonality, and of course the informality of a majority of MSMEs, given that a big chunk of MSMEs are micro enterprises. This suggests that when shocks hit MSMEs, they feel it fast, long before GDP numbers actually catch up. Now, with respect to NPLs, credit risk only has a significant relationship in trade, where a high NPL ratio tends to tighten credit conditions in the short run. And the study reveals a very slow recovery after a shock across all sectors, suggesting that MSMEs remain fragile. Practically, this confirms what we already know, that a majority of MSMEs collapse within just a few months of a financial strain, owing to inadequate buffers. So the action points for banks and policymakers are these. The paper, or rather the study, recommends that banks deepen the adoption of sector-linked risk-based pricing models, ensuring that MSMEs are priced based on cash flow patterns. Banks must therefore also invest in data systems that reward positive, albeit informal, financial behavior. Secondly, the study recommends that banks should redesign their what I call treasury-happy balance sheets to favor productive risk-mitigated MSME sectors through blended finance as well as partial guarantees. The study also recommends that banks incorporate sectoral GDP dynamics and cash flow cycles into their credit scoring using transactional data to predict repayment capacity more accurately. Also, banks should adopt sectoral credit exposure dashboards with early warning triggers. And just like what the EU does, internally, banks should deploy NPL heat maps and limit exposure in overheated or highly volatile sectors while maintaining flexibility in others. The study also recommends that banks should increase the use of shock-absorbing products such as seasonal loans, invoice discounting, as well as revenue-linked repayment plans. And as well, policy should promote MSME credit insurance or emergency credit facilities through fintech partnerships. And also, the study recommends that banks should deepen co-created embedded financing solutions, especially with large off-takers, so as to serve MSMEs in their value chain with pre-validated credit. Now, as I end, this is something I've been thinking about for some time, and I just wanted to propose an alternate way of truly supporting MSMEs, given that in reality, MSMEs are very diverse. So the question I've always had is, who are really MSMEs? Who are these people? Who are these businesses? And like I earlier mentioned, MSMEs are categorized either as micro, small, or medium. And of course, whether they are formal or informal. But I believe there are other categories that we need to appreciate. And these are three. The survivalist MSMEs, and this is the Mamamboga, the Boda Boda riders, whose businesses are their sole livelihood. And so if it fails, the household income collapses. And as a result of that, they are highly vulnerable and have very low buffers in the event of shocks. The second category is around the growth-oriented or opportunity-oriented MSMEs. And these MSMEs are run by entrepreneurs who see a scalable market, and as such, they may reinvest their profits to expand, hire staff, as well as formalize over time. The third category I see is the side hustle MSMEs, the hustlers. But these hustlers, from my point of view, is those who tend to be, or rather the side hustle MSMEs are those that tend to be run by formally employed individuals who run a business on the side. And thus, they don't really rely on business income for survival, but that does not stop them from borrowing to expand their business. And as a result, they often have better repayment capacity since they can cross-subsidize with their salary income. So to me, this distinction matters because obviously the risk profiles differ. Where the survivalist MSME missing 1 week of sales, this MSME may default. But the side hustler may cushion this miss with their salary. Yet many credit policies as well as banking policies altogether just lump them together. And also this has an impact on policy targeting, whereby if a government subsidy or guarantee is, in my opinion, if a government subsidy or guarantee is really meant to uplift the livelihoods of these MSMEs, then it should, and this is my opinion again, target survivalist MSMEs. But if the aim is to spur innovation and growth, then growth-oriented MSMEs should be the priority. Lastly, it impacts, obviously, the distinction, how banks strategize around MSME lending, whereby banks should not just equalize these MSMEs, but instead design differentiated products such as microloans with flexible repayment for these survivalist MSMEs, or salary-backed SME credit lines for side hustle MSMEs, given the fact that, quote unquote, they have lower risk. So all I'm saying is that MSMEs are not equal, and lumping them together hides the fact that a salaried person with a side hustle has far more resilience than someone who relies on that business for their livelihood. So strategically, banks and policymakers need to rethink segmentation within the MSME sector just to score highly on equity as opposed to equality. Thank you.
Thank you. So I'll be brief as requested. Yeah, so thank you so much, Stephanie, for that great paper. So I'll just go straight into it and just share some comments from reading that. So I had the opportunity to read the paper, and I would say that it was a well-written paper, and it provided good insights for the MSME sector in Kenya. And really, from what she's presented, I think we have a better understanding now of the factors that can influence the credit allocation to MSMEs. So I would say when Stephanie was presenting, she also started off with some good insights, which I thought she can incorporate even in her written work, because I believe that as someone who will be reading your work, they will be very interested to know about the landscape in Kenya, how many MSMEs operate there, how much is lent. You mentioned that in your presentation. What is the proportion that is lent to the different sectors or to the various sectors? And I think that can also build a case for why you focused on the 3 sectors. I was personally wondering, for example, why you didn't include manufacturing. I believe that's also another large MSME sector or another area that is also quite large. Also, perhaps even the role of government institutions like the State Department for MSME Development, have they played a role in helping the MSMEs get financing? And also, you mentioned about some MSMEs and where they get their financing. Are there other avenues apart from the banking sector? So I think that would really add value to your paper. And I'm glad that you did mention some of those in your presentation. Now, in terms of some of the technical things, I would say your objectives and research questions would need to match. And also, I wasn't quite sure, you mentioned it in your work, how the results from this research can inform monetary interventions. Maybe I was thinking of monetary policy, but maybe that can come out more clearly. For the literature review, I thought that you did a good job. Probably just to summarize what I have, the bank lending channel of monetary policy transmission. Again, you mentioned that as one of the theories or theoretical frameworks. Again, I wasn't too sure how that really relates to this research. Also, for the papers you've cited, indeed, your paper is unique in that it's disaggregated, looking at the different sectors and how credit to these sectors, or what influences credit to the various sectors within the MSME framework. However, it would be nice to also see what has been done in Kenya just to build the case for your research, which indeed is unique, because I also tried looking and I didn't find perhaps similar papers. And I also found a paper that had been done in India looking at the sectoral analysis. Perhaps you could also gain from that as well. Probably, maybe as we end, is the methodology I thought was appropriate. For the models, there's some notation I thought you could look at again, because some of your variables do not vary across the sectors. But perhaps what I wanted to find out was, because I had the privilege of seeing the results that you have, is that I saw in the correlation matrix, there was a very high correlation between the lending to the various sectors and GDP, correlations of up to 0.97. So I thought, might that present a multicollinearity issue? And if that's the case, are your results reliable? Or are there other ways you can check for this multicollinearity among the variables? So that was one thing. And also another issue was now with the interpretation of the models that I kindly request for you to look into. Maybe if someone else points this out, was your Y variable, which is your credit extended to the MSME sector, is in natural logarithms. However, you have some independent variables not in natural logarithms. This would be a log level model. And so I was now wondering, does it then call for a semi-elastic interpretation? In other words, the coefficients, do they have to be multiplied by 100 for them to make sense? So, and if that's the case, then that changes the numbers that you're presenting now in terms of interpretation. And perhaps I had two questions on the results, but probably the one that I'll ask now is, why might there be a negative relationship between credit extended in the previous quarter and this quarter? At least that's what I believe I saw from the results. Why might that be? And finally, just to end, you spent good time giving us recommendations, even in your presentation. And I also thought, to strengthen that, we could also learn from other regions. And I think you can add that in your paper. So, for example, I saw that EcoBank Ghana uses mobile money transaction histories as a credit assessment tool. Maybe that may be something that banks could learn. In other jurisdictions like India, they've created platforms where MSME invoices can be traded to get financing. I wonder if we can also learn from other jurisdictions, also as we also support the findings from your paper. Yeah, so thank you. Overall, it was a great paper and I enjoyed reading it, and indeed very practical implications for the banking sector. Thank you.
Thank you, Dr. Caroline, for that, keeping it brief and to the point. Now we can take maybe two questions, comments, suggestions before we progress to the next phase, the last session of the day. Oh, was it that clear? Yes, done. And okay, you can take Dan's comments and then
So, as I introduce myself, from TBA. When you were presenting, I didn't hear anything to do. First and foremost, congratulations. You have really covered a lot about the disaggregated. You have deployed a disaggregated approach, which is quite insightful and useful. But I didn't hear about any sort of, whether I looked at the gender disaggregation, whether there are differences when it comes to access to credit between male and female entrepreneurs or other enterprises, SMEs. That would be very useful if it was not covered. The second question is, rather comment, is I think it will also add value to the paper if you have a bit of discussion about what you refer to as banks' preference to park the funds in safer investment like government securities. Are we observing a trade-off with these preferences, which end up penalizing SMEs? Just a bit of that discussion would add value to the paper. Thanks.
okay. So, without any other additional comment, do you want to comment? Okay.
So I'll start with the last question and comment. With respect to gender, no, I didn't look at gender. In fact, one of the things I should have mentioned is that in terms of further research, it would be important for whoever does this research to also look at not only just the micro enterprise angle, which is important, but also gender, because that influences. One other thing I noted as I was conducting this research and speaking to various industry players is in the manner in which they classify MSMEs, how they truly classify. And that's why I came up with that thought of salaried side hustle employees. Because if Stephanie walks into ABSA, I do not want to let them know that I'm employed at I&M. I will tick the box of business and tick the box of this various income range. How then do you verify that I actually earn this much? And will you actually classify me as an MSME if I state that I have a business, my source of income is business and all that from income? So I just wanted to highlight that as an area of further research, as well as gender. In terms of bank liquidity, I think there's been a lot of research here in Kenya, not even research, commentary, evidence-based research on the correlation between bank liquidity, higher levels of bank liquidity, and packing into government securities. Even when financial results are released, you actually see that correlation. There seems to be a correlation, but perhaps it would be insightful if another author is able to look into this. Now, in terms of Dr. Caroline, thank you so much for your comments. And yes, with respect to let me talk about the natural log. The natural logs were on GDP and credit. Everything else was a ratio, or either a ratio or a percentage, which I put in a decimal format. So yes, I'll take that into consideration with respect to how to interpret the results, especially between those in natural log and GDP and now the other ratios or the percentages. The rest I will look at and let you know. Thank you so much. Yeah.